Hello, everyone. Today is April 18th. My name is John Kirkpatrick, an investment strategist at Henderson Brothers Financial Partners. And today I am joined by my colleague on our investment team, Joseph Kelly. We wanted to get together and provide a brief update on the markets, given everything that's been going on. So it's been just over 2 weeks since what the media dubbed Liberation Day, the day that the new U.S. tariff policy was announced. And while the dust is still settling, we are starting to get a clearer picture of where things stand. So starting with the tariffs, the flurry of the shocking announcements has cooled off quite a bit, but tariffs still remain front and center in the headlines and in market conversations. So where are we now? Well, the reciprocal tariffs that were announced on Liberation Day have been paused for 90 days in order to allow time for the administration to have country-specific negotiations. So currently, we have a universal 10% tariff rate, which is applied across the board on all imports into the US. And this is in addition to any pre-existing tariffs that were in place. However, China is the major outlier. So after retaliating with its own 125% tariff on US goods and in also announcing the export ban of rare earth minerals, which are critical for manufacturing and technology products, the US responded by raising Chinese import tariffs to 145%. Just a few days ago, though, we did get some relief. So certain products from China, like semiconductors, smartphones, TVs, some other electronics, will be placed in a separate bucket, which is exempt from the 145% rate. The exact structure, though, of that exemption is still being finalized. So where does that leave us? The blended U.S. tariff rate, the effective tariff rate on goods coming into the U.S. today, is approximately 23%, which is still a massive increase from just 2.3% in 2024. So let's kick it back over to Joe to talk through some of the potential impacts of the tariffs.
Thanks, John. So as John said, the reciprocal or country-specific tariffs were announced on April 2nd, and there was a 90-day pause. So until early July, we can expect those being withheld. And what we want to see is some successful trade negotiations relating to policies with these individual countries, but there are some challenges for these trade negotiations. The first being the number of countries. On April 2nd, the countries specifically targeted were over 100 countries and territories. So the 90-day time frame for this pause doesn't leave that much time for successful negotiations. Additionally, we're talking about highly complex issues. We're talking about trade supply lines that have been set up over multiple decades. And then finally, we have to consider that there could be a change relating to the White House's goals and objectives that they're trying to achieve over these 90 days, which also could cause some additional challenges. Now, if we don't see successful trade negotiations, who could be impacted the most? Within the US, we expect lower income brackets could potentially have a higher hit to their overall disposable income from a percentage basis. Additionally, outside of the US, countries such as China, which have the highest tariff rate associated with them, would definitely have an economic shock. And then additionally, there are countries that have significant reliance on the US exports with regards to their overall economic output, such as Vietnam and Cambodia. If they're unable to negotiate lower tariffs prior to July, they can definitely expect hits to their overall economic output as well. Countries that may fare better include the UK, Singapore, and some Latin American countries such as Brazil. They all were initially announced only 10% reciprocal tariffs on April 2nd. So their tariffs aren't expected to increase after July. So they actually might gain market share with regards to exports to the US. So they should fare better in this situation. Now I'm going to switch over to investment returns. The S&P 500 has had a very volatile year so far in 2025. On a year-to-date basis, the index that tracks the largest 500 publicly traded companies is down roughly 10%, but it is still positive on a one-year time frame, over 5%. International developed stocks, stocks that are in countries such as Japan, the UK, and France have done better. They're positive over 5% on a year-to-date basis. But what has performed the best and performs quite well during times of uncertainty is gold. Gold is up over 25% so far in 2025. Now, some quick individual stock news before I pass it back to John. Eli Lilly is a pharmaceutical company in the US, and they have had some positive stock performance over 15% over the past week since they announced that they're having some clinical success relating to their weight loss pill. Additionally, Netflix reported 25% year-over-year earnings growth, so their stock has done quite well. But a stock that has not done well has been United Healthcare. It's down significantly due to their earnings miss this Thursday. So, John, I'm going to pass it back to you to talk about the economy.
Thanks, Joe. So let's start with the Federal Reserve, which is navigating a very challenging landscape currently. Not helping that is the public pressure on the Fed to cut interest rates from President Trump has ramped up significantly just this week. He said and this is a quote, Powell's termination cannot come fast enough, referring to the Fed chair, Jerome Powell, whose term runs through May of 2026. The Fed is in a tough spot. So on one hand, tariffs are inflationary. They're expected to cause higher prices and a potential rise in unemployment as growth slows. But on the other hand, cutting rates too soon could fuel inflation further. So Chairman Powell has made it clear currently, as of this week, the Fed is waiting for more clarity on the full impact of trade policy before they make any type of move. The next Federal Reserve meeting is on May the 7th, which is 19 days away. Markets largely expect no change in rates during that meeting. And then after that, the Fed has 5 more meetings throughout the remainder of this year. As of right now, markets are pricing in 3 to 4 rate cuts to take place this year, which is equivalent to 75 to 100 basis points or 1%. That would directly impact your short-term yield-sensitive investments, such as money market funds and CDs. So why might the Fed be cautious to start cutting rates preemptively? 1-year consumer inflation expectations have doubled since the start of the year and now sit above 6%. Longer-term 5-year expectations are also elevated, sitting above 4%. So the consumer expectations are much higher than the market-based inflation expectations, but those have modestly moved upward as well. So long-term projections, though, from the market do remain fairly stable, which is a positive sign for now. In terms of growth, we are starting to see some cracks. So yes, we just got the March retail sales report, and it did come in stronger than expected. But the spike was primarily driven by motor vehicle sales and parts. That's likely consumers trying to front run the upcoming price increases that are coming from the tariffs. And meanwhile, new order surveys, which offer a 6-month forward-looking view, have nearly fallen off a cliff after trending upward since 2022. Lastly, the labor market, which has remained resilient, unemployment is at 4.2%. That number is, though, expected to tick higher as economic growth starts to slow. I'm going to pass this back to Joe to close us out.
Thanks, John. Again, I'm an investment strategist with Henderson Brothers Financial Partners, and so is John Kirkpatrick. We have an overall cautious outlook with the level of uncertainty currently in investment markets, but we're always happy to take any questions that you may have. So please reach out if you have any questions. Thanks again for joining. Again, reach out if there's anything that we can help out with. Thank you.
Thank you.